The Iran shock is coming, and most people are not thinking about it in the right way. They are thinking about the headline. They are thinking about oil for the next week, fear for the next month, and stock prices for the next quarter. That is not how I look at it. When a shock comes into the system, the question is not simply what goes up tomorrow or what goes down tomorrow. The question is how the shock moves through energy. Inflation, interest rates, corporate profits, consumer behavior, liquidity, psychology, and finally asset prices. That chain is what matters. If you understand the chain, you do not have to be surprised by the outcome. You may still be wrong on timing. You may still be early. You may still feel pain while the system adjusts. But you will not be one of the investors who wakes up after the damage has already happened and asks why nobody warned them. Most investors do that. They wait for the news to explain the event after the market has already priced it. They wait for the expert on television to tell them the war is serious after oil has already moved. They wait for the fear to become obvious after portfolios have already been hit. That is a bad process. The better process is to look at the system before the shock becomes fully visible. Right now, oil prices are moving higher. When oil prices move higher, the cost of moving goods rises. The cost of producing goods rises. The cost of running businesses rises. The price at the store eventually rises. That creates inflation pressure. Inflation pressure does not stay inside the oil market. It moves into the economy. When inflation rises, households get squeezed. Businesses face higher input costs. Margins compress. Consumers buy less. Companies that were already fragile begin to show their weakness. Then the next part of the chain begins. The Federal Reserve has less room to help. If growth slows because oil prices are high, the usual response would be easier monetary policy. But if inflation is rising at the same time, the central bank cannot simply cut rates without risking another inflation problem. That is the difficult environment people call stagflation, weak growth, and high inflation at the same time. That is the environment investors fear most because there is no clean solution. If the Fed cuts too quickly, inflation can accelerate. If the Fed stays tight, the economy can slow further. If oil keeps rising, the problem spreads through everything. That is why a geopolitical shock can become a market shock, and a market shock can become a portfolio shock. But this is where the average investor and the disciplined investor separate. The average investor sees a crash and feels only fear. The disciplined investor sees a crash and asks what is being repriced, what is becoming cheaper, what will survive, and what will become stronger when the cycle turns. This is one of the most important principles I learned by studying history and markets. The reason for the crash changes, but the structure repeats. Sometimes the reason is an oil shock. Sometimes it is inflation. Sometimes it is a war. Sometimes it is a credit bubble. Sometimes it is a technology bubble. Sometimes it is a pandemic. The headline changes, but the cycle does not change as much as people think. Markets move through fear, forced selling, capitulation, stabilization, recovery, and then another expansion. They do this again and again because human nature does the same things again and again. People get too optimistic near the top. They get too fearful near the bottom. They extrapolate the present into the future. They forget that systems correct. They forget that the strongest businesses often use bad environments to increase their advantage. A crash by itself does not destroy a thoughtful investor. A crash destroys the investor who has no plan, no liquidity, no understanding of what he owns, no risk controls, and no ability to hold through volatility. That is the key distinction. A collapse is frightening if you are unprepared. A collapse is useful if you are prepared. That does not mean you run into the market blindly. Blind courage is not a strategy. Buying every falling stock is not a principle. Buying because something is down 40% is not a system. You need a shopping list before the crisis. You need a process before the crisis. You need to understand what kind of companies can survive the shock and compound after it. That is what I want to focus on. Not fear, not prediction or portfolio spikes. Many people immediately say buy oil. That may work for a trader. It may work for a few months. It may work if you understand the timing, the supply dynamics, the futures curve, and the exit. But that is not the way I think about building wealth over 10, 15, or 20 years. Oil is cyclical. It moves up, it moves down, and it creates opportunities. But it is not automatically a long-term compounding machine. The same is true for many commodities. They can protect you in a phase of the cycle, but they do not necessarily create the kind of durable compounding that changes a portfolio over decades. Going entirely to cash is not the answer either. Cash feels safe in a crisis because the number on the statement does not move. But if inflation keeps reducing purchasing power, cash is quietly losing. It can be useful as a tactical reserve. It can be very valuable when everything else is falling. But as a permanent strategy, cash is not safety. It is slow erosion. Chasing defense contractors for one shock is not enough. Chasing defensive stocks because people are scared is not enough. Healthcare, telecom, consumer staples, and defense may have their periods. They can provide shelter in certain environments. But if the objective is to build a portfolio for the next decade, the real question is different. Which businesses are strong enough to survive the shock, necessary enough to keep growing through the shock, and positioned well enough to become more valuable after the shock? That is the question. I do not want to own the noise. I want to own the engines. When the market panics, it often sells everything together. Good businesses fall with bad businesses. Essential companies get priced as if they are optional. Long-term winners get treated like short-term trades. That is where opportunity appears. The opportunity is not created by the shock itself. The opportunity is created by the forced selling and bad thinking that the shock produces. This is why survival is such an important word. A weak company can be destroyed by a bad cycle. A strong company can be marked down by a bad cycle, survive it, and then become much more valuable when the world recovers. Amazon is a good example of the principle. It survived periods when the market did not believe in it. It survived enormous drawdowns. It survived more than one major crash. And because the underlying business kept improving, the long-term result was determined less by the panic and more by survival, execution, revenue, margin, and dominance. That is how I think about this moment. The Iran shock, or any similar geopolitical oil shock, can create inflation pressure. Inflation pressure can weaken macro conditions. Weak macro conditions can hurt markets. But market weakness can also create entry points in the businesses that are tied to the most durable forces of the next decade. So the question becomes simple. What are those durable forces? The first one is reliable power. The second is artificial intelligence infrastructure. The third is memory. The fourth is semiconductor production. The fifth is decision-making and chaos. The sixth is automation and real-world productivity. These are not separate ideas. They are connected parts of the same system. AI needs power, AI needs cooling, AI needs chips. AI needs software to help organizations use data and make decisions. AI needs cybersecurity, AI needs cloud infrastructure. AI needs companies that can turn technology into productivity. When you see it that way, the shock does not change the long-term direction. It may accelerate the need for the strongest companies because in chaos, efficiency becomes more valuable, energy becomes more valuable. Infrastructure becomes more valuable and clear decision-making becomes more valuable. That is why I do not view the coming volatility only as a risk. I view it as a test. It will test weak investors. It will test weak companies. It will test weak balance sheets. It will test weak narratives. But it can also reveal where the true strength is. Let me go step by step over the last 25 years. The stock market has gone through multiple forms of chaos. There was the technology crash. There was the lost decade, there was the financial crisis, there was the pandemic crash, there was the inflation and rate shock, there were wars, recessions, bubbles, panics, and periods when many people thought the market was permanently broken. And still, over the long arc, the market rose. Because productive assets grew, revenues grew, profits grew, innovation continued, and the best companies kept adapting. That does not mean every company won. Many did not. It means the system rewards productive capacity over time. This is why crashes are not usually what destroys long-term portfolios. Inflation destroys portfolios. Bad behavior destroys portfolios. Impatience destroys portfolios. Panic selling destroys portfolios. Buying weak companies with no durable advantage destroys portfolios. A crash can be painful, but a crash also gives you lower prices. Inflation is more subtle. It reduces the value of money while people think they are being safe. If your dollar loses purchasing power over time, sitting still is not neutral. It is a decision. So the right question is not whether there will be volatility, there will be. The right question is how to own assets that can grow through cycles and how to add to them without losing control of your emotions or your risk. That brings me to the first major sleeve of the portfolio I would study in an environment like this: energy, but not simply oil. If AI is going to become one of the dominant economic forces of the next decade, then energy is not an optional input. It is the foundation. AI data centers are extraordinarily power hungry. They require reliable electricity, cooling, and infrastructure that can function even when the grid is stressed and geopolitical uncertainty raises the cost of traditional energy. That is why I am not interested in only chasing the price of oil. I am more interested in companies that help solve the long-term energy bottleneck. The source names 3 examples in this energy sleeve: CG, VRT, and Bloom Energy. CG is connected to the nuclear side of the power problem. Nuclear matters because the AI cycle needs baseload power, not only intermittent power and not only energy that depends on one commodity price. VRT is connected to cooling and infrastructure. If data centers expand, cooling does not become a small detail. It becomes mission critical. Without cooling, computing power cannot operate efficiently. Bloom Energy is connected to on-site production, the kind of energy solution that can reduce dependence on a stressed grid. These companies represent a broader idea. The AI supercycle is not only about algorithms, it is about physical constraints. Power is physical. Cooling is physical. Data centers are physical. Infrastructure is physical. And when the market becomes obsessed with the most visible AI names, it often misses the companies that make the system possible. That is the picks and shovels idea during a gold rush. The winners are not only the people digging for gold, often the durable winners are the ones selling the tools, building the infrastructure, and solving the bottlenecks. In an AI cycle, the bottleneck is not just intelligence, it is the physical capacity to run intelligence. That is why energy belongs in the discussion, but energy is only the first bottleneck. The second is memory. As artificial intelligence becomes more complex, as models take on more context, as agents and super agents are asked to perform more complicated tasks, the need for memory rises dramatically. People often focus on GPUs because GPUs were the first obvious bottleneck. But as the system evolves, the memory bottleneck becomes more important. If you ask AI to do more, remember more, compare more, reason across more data, and operate with more context, you need more memory. That is a simple cause and effect relationship, and the source makes a clear point. A small number of companies dominate a very large part of the memory market. It identifies Micron, SK Hynix, and Samsung as the key names, with Micron as the US-centric focus. The idea is not that the price will go up every month. The idea is that the structural demand for high bandwidth memory can become one of the central bottlenecks in the AI build-out. If supply takes years to build and demand rises faster than expected, the companies already positioned in that market can have an advantage. That is the principle. Micron had already fallen sharply from the source's earlier entry point, but that alone does not invalidate the thesis. A strong long-term thesis can experience large drawdowns. In fact, many of the best long-term positions feel uncomfortable in the early stages because the market does not move in a straight line. The question is whether the underlying demand, revenue, free cash flow potential, and strategic position are improving. That is the kind of question that matters. The third sleeve is production. This is where the semiconductor chain becomes central. AI may look like software to the end user, but underneath it is a production problem. You need GPUs, you need advanced chips, you need lithography, you need foundries, you need design software. You need connectivity. You need the whole production chain to keep expanding. The source names NVIDIA and AMD as companies tied to the GPU bottleneck. It names ASML as the company producing the lithography machines that make advanced semiconductors possible. It names TSMC as the dominant manufacturer of many of the most advanced chips. It names ARM and Cadence on the design and software side. It names AET on the connectivity side. The important point is not to treat these names as a random basket. The important point is to understand the system they represent. If AI demand grows, the need for computing infrastructure grows. If computing infrastructure grows, chip demand grows. If chip demand grows, manufacturing capacity matters. If manufacturing capacity matters, lithography matters. If chip complexity rises, design tools matter. If systems become bigger and more connected, connectivity matters. This is a cause and effect chain in normal times. Production capacity is important. In chaotic times, it becomes even more important because countries and companies do not want to depend on fragile supply chains for their most important technologies. Geopolitical uncertainty makes production resilience more valuable, not less valuable. That is why I would not think of semiconductors only as a technology trade. I would think of them as the industrial base of the next computing cycle. The fourth sleeve is decision making in chaos. This is where Palantir appears in the original argument. When the world becomes more chaotic, governments, large companies, defense organizations, banks, manufacturers, and critical infrastructure operators have a problem. They have too much data, too much uncertainty, and too many variables moving at the same time. They need to make decisions. They need to understand supply chains. They need to understand risk. They need to understand where resources are going. They need to respond faster than older systems allow. The source presents Palantir as the company that helps organizations make decisions in chaos. That is the core reason it belongs in this framework. It is not just an AI stock. It is not just a government contractor. It is a company tied to the need for decision systems when complexity rises. That is why, in the original argument, Palantir is the flagship example. The source also names CrowdStrike on the cybersecurity side. That fits the same principle. When systems become more digital, more automated, and more interconnected, the cost of cyber failure rises, chaos increases the need for security. Cybersecurity is not a luxury when digital infrastructure becomes critical infrastructure. The source also names Datadog and MongoDB on the database visibility and monitoring side. It names Oracle, Microsoft, Google, and Amazon on the database and cloud side. Again, the point is not that every company in this group is identical. The point is that they all touch the same broad system data, cloud visibility, security decision making. In a simple world, these are useful. In a chaotic world, they become essential. The fifth sleeve is automation and real-world productivity. If inflation rises and labor is expensive, businesses need productivity. If oil rises and supply chains are stressed, businesses need automation. If the world is uncertain, businesses need tools that allow them to do more with less. That is why the source places Amazon, Tesla, Meta, SoFi, and Robinhood into the productivity and platform discussion. Tesla is linked to robotics and full self-driving. Whether one agrees with every expectation or not, the framework is that automation of the physical world can become extremely valuable if it works at scale. Meta is linked to advertising efficiency when businesses are under pressure. The ability to acquire customers more cheaply and more precisely matters. Amazon is linked to both AWS and the retail data and infrastructure machine. The source emphasizes that Amazon had done very little over a period when the company itself had improved, which creates the argument that it may represent one of the more interesting opportunities. SoFi is presented as a financial technology platform that has been on the list for some time. Robinhood is added as another name that belongs in the broader financial and productivity platform conversation. The important idea is that productivity becomes more valuable when the world becomes harder. When money is easy, many weak businesses can survive. When money is tight, energy is expensive, inflation is high, and uncertainty is rising, companies need tools that increase output, reduce friction, improve speed, lower cost, and automate decision making. That is the logic of the portfolio sleeve. But having the right list is still not enough. This is one of the biggest mistakes investors make. They think a good company is a strategy. It is not. A good company can be a terrible investment if you buy too much too fast, with borrowed money at the wrong time, and without a plan for volatility. The system matters more than the excitement. That is why I would approach a list like this with several principles. First, I would keep a strong S&P 500 core. Many investors believe they can beat the market by owning only individual stocks. Some can for a period. Most cannot do it consistently because they underestimate concentration risk, timing risk, behavioral risk, and the fact that the index itself owns many of the winners. A broad core gives the portfolio a foundation. It keeps the investor from turning every decision into a single stock bet. It also reduces the emotional pressure of trying to be perfect. Second, I would use a disciplined DCA framework. Having a list of great companies does not tell you when the bottom is. No one rings a bell. If the Iran shock creates a market decline, it may be fast or slow. It may fall in stages. It may bounce violently before falling again. It may not behave the way anyone expects. That is why buying slowly matters. You do not know where the bottom is. You do not need to know exactly where the bottom is if you have a system that allows you to accumulate through weakness without exhausting your cash too early. Third, I would never use margin for this kind of long-term plan. Debt turns volatility into a possible forced sale if you own strong assets without leverage. You can survive drawdowns. If you own strong assets with too much leverage, the market can force you out at exactly the wrong time. That is how good ideas become bad outcomes. Fourth, I would avoid panic buying. This is just as important as avoiding panic selling. Some investors hear that a crash is an opportunity and immediately buy too aggressively. Then when the market falls another 20%, they have no cash left and no emotional strength left. The right process is patient, slow, slow, slow. You want enough money and enough patience to go through a long buying process. A crisis can last longer than you expect. The market can be irrational longer than your excitement lasts. You need a plan that survives time. Fifth, I would evaluate companies by the 5 characteristics that matter in this environment. A company should not merely be tied to a popular theme. It should connect to a real bottleneck. It should be able to thrive in chaos, or at least become more valuable because of the problems chaos creates. It should offer certainty, productivity, security, power, data, infrastructure, or efficiency in uncertain times. It should be mission critical in a way that cannot easily be cut when budgets tighten. And it should have strong fundamentals, not just a good story. That last point is crucial. The market can talk endlessly about headlines, valuation ratios, insider selling, social media narratives. Or whether a company is loved or hated, those things can matter in the short term. But over time, price follows the ability of the business to grow revenues, expand margins, generate profits, and improve its competitive position. That is why the source comes back to Palantir and its revenue and margin development. People argued about the stock for many reasons. Some said the valuation was too high, some said insiders were selling. Some said it had too much government exposure, some said it had not enough government exposure, some said competition would destroy it. But the core question was whether revenue, gross margins, operating margins, and net income margins were improving. If those lines keep moving in the right direction, the business becomes more valuable over time. Not every high multiple company will justify its price, many will not. But if a company truly expands margins, grows revenue, becomes more essential, and strengthens its position, the long-term result is usually determined by those fundamentals, not by the noise around it. This is one of the hardest ideas for investors to internalize because noise is emotionally louder than fundamentals. A headline feels urgent, a price drop feels personal, a downgrade feels authoritative, a social media panic feels contagious. But revenue and margins are the machine underneath the story. If the machine is improving, the investor should pay attention. If the machine is deteriorating, the investor should not be comforted by a popular narrative. That is the principle. Now bring this back to the Iran shock. If oil rises sharply, inflation pressure returns. If inflation pressure returns, the Fed has a harder problem. If the Fed has a harder problem, markets may reprice. If markets reprice, many investors will panic. If investors panic, high-quality companies can become available at better prices. And if you already know which companies are connected to the durable bottlenecks of the next decade, you can use that volatility instead of being used by it. That does not mean every company on the list should be bought today. That does not mean every price is attractive. That does not mean every thesis will work. It means the investor should prepare the list before the fear arrives. When fear arrives, the unprepared investor looks for guidance. The prepared investor looks at his plan. That is the difference. The market will always give people reasons to sell. There will always be wars. There will always be recessions. There will always be inflation scares. There will always be interest rate scares. There will always be crashes, pandemics, bubbles, and political shocks. But there will also always be companies solving problems, increasing productivity, building infrastructure, improving margins, and growing into the next cycle. The investor's job is not to predict every shock. The investor's job is to survive the shocks and own the assets that benefit from the forces on the other side. That is why I do not want to be moved by every headline. I want to understand what is happening in the system. Oil pressure is one part of the system. Inflation is another part. Fed policy is another part. Consumer weakness is another part. Market fear is another part. Long-term technology demand is another part. AI power demand is another part. Memory constraints are another part. Semiconductor production is another part. Cybersecurity is another part. Decision-making is another part. Automation is another part. When you connect these parts, you stop seeing the market as random noise. You start seeing it as a machine with flows, pressures, and feedback loops. That is how I would think through this. Not as a call to panic, not as a call to chase, not as a call to be 100% in cash, not as a call to buy oil because oil is rising, but as a call to prepare. Prepare your watch list, prepare your cash plan, prepare your DCA system, prepare your risk limits, prepare your mindset, prepare to buy slowly if the market gives you better prices, prepare to hold through volatility if the fundamentals remain strong, prepare to admit when a thesis is wrong if the fundamentals break. That is how you turn chaos into opportunity without gambling. The biggest danger in a moment like this is not the Iran shock itself. The biggest danger is reacting to the shock without principles. Some investors will sell everything at the bottom because the headlines frighten them. Some investors will buy everything too early because they think every dip is a bargain. Some investors will chase oil after the move has already happened. Some investors will hide in cash and lose purchasing power slowly. Some investors will buy weak companies because they look cheap. Some investors will use leverage because they are impatient. Those behaviors are what create permanent damage. The shock creates volatility. Bad behavior creates permanent loss. That is why the system matters. The best long-term investors are not calm because they know the future. They are calm because they have a process for not needing to know the future precisely. They know the world will produce disorder. They know markets will overreact. They know strong businesses will sometimes be sold with weak ones. They know liquidity is valuable in a panic. They know leverage can be fatal. They know inflation is a quiet enemy. They know that revenue margins and competitive position matter more than the noise. They know that if they can stay rational when others become emotional, they have an advantage. That is the real opportunity. It is not one stock. It is not one perfect entry point. It is not one prediction about Iran, oil, or the Fed. It is the combination of preparation, discipline, and understanding how the system works. The Source S portfolio map is not complicated when you reduce it to principles. Energy infrastructure because AI needs power and cooling. Memory because AI needs context and capacity. Semiconductor production because AI needs chips and manufacturing. Decision systems because chaos increases the value of intelligence and clarity. Cybersecurity and data infrastructure because digital systems need protection and visibility. Automation and productivity platforms because the world needs to do more with less. A broad index core because humility matters. A DCA plan because timing is uncertain. No margin because survival matters. Slow buying because the bottom is unknowable. Fundamentals because noise does not compound. That is the framework. If the shock comes and markets fall, the investor with no framework will ask, "What should I do now?" The investor with a framework will already know what to study, what to avoid, how much to buy, how slowly to buy, and what evidence would make him change his mind. That is the advantage in investing. The future is never perfectly clear. It was not clear during the dot-com crash. It was not clear during the financial crisis. It was not clear during the pandemic. It was not clear during the inflation shock. It will not be clear during the next oil shock either. But clarity of process can exist even when clarity of prediction does not. That is what I want you to take from this. The world is not going to become calm so that you can invest comfortably. Markets are not going to remove uncertainty before giving you opportunity. You will not get perfect evidence at the perfect price with perfect emotional comfort. Opportunity usually arrives wrapped in fear. That is why most people miss it. They want certainty before they act. But by the time certainty arrives, the price has usually changed. So the question is not whether fear will appear, it will. The question is whether you have done the work before it appears. If oil keeps rising, understand the inflation chain. If the Fed cannot help easily, understand why the market is nervous. If consumers are squeezed, understand why weak companies are vulnerable. If the market sells off, understand which strong companies may be dragged down unfairly. If AI continues to demand power, memory, chips, infrastructure, security, data, and productivity, understand which businesses are tied to those needs. If you buy with a plan. If you wait with a plan. If you hold because the fundamentals justify it, not because you are emotionally attached. This is how you turn a frightening environment into a rational decision-making environment. And that is the essence of investing, not prediction decision-making under uncertainty. The Iran shock may be the headline. Oil may be the trigger. Inflation may be the mechanism. The Fed may be constrained. Markets may fall. But the deeper story is the same one that has repeated through market history. Fear punishes the unprepared and rewards the prepared. Weak companies get exposed. Strong companies survive. The impatient transfer assets to the patient. The emotional sell to the disciplined. The people with no system become liquidity for the people with a system. That is why I do not want to spend my time predicting every headline. I want to build the framework before the headline matters. I want to know which businesses solve real problems. I want to know which bottlenecks are structural. I want to know which companies are mission critical. I want to know which fundamentals are improving. I want to know how much I can buy, when I will add, when I will stop, and what evidence matters. That is how you prepare for the next decade. Not by being fearless. Fearless people often do foolish things. The goal is not to be fearless. The goal is to be principled when fear appears. A principled investor can look at chaos and say, "I do not know exactly what happens next, but I know how to respond." That is enough, because over long periods, wealth is not built by reacting to every shock. It is built by owning productive assets, adding to them intelligently, controlling risk, avoiding forced selling, and allowing the best businesses to compound through cycles. The next shock will come. The reason may be Iran, it may be oil, it may be inflation, it may be something else entirely, but the preparation is the same. Understand the chain, respect the risk. Do not chase the obvious trade too late. Do not hide permanently in cash. Do not use leverage. Do not buy blindly. Do not confuse a falling price with a good investment. Study the companies tied to the durable forces. Build the list before the crash. Buy slowly if the opportunity appears. Hold only if the fundamentals keep confirming the thesis. And remember that the market will always test your ability to separate noise from the machine. That is where the money is made, not in the headline, not in the panic, not in the perfect prediction, in the disciplined response. If you understand that, then the next shock does not have to be the thing that wipes you out. It can become the moment that reveals whether you were prepared. And if you were prepared, it may become one of the most important wealth-building opportunities of the decade.